should be recording now. The recorder is on. Let me go to the... All right. I want to welcome everybody to the e-learning on the 25th of October 2018. All right. The agenda we're going to go over is I'm going to put out some member questions and just cover those and make sure I cover it in depth during the presentation. And we're going to go over some chart settings and some favorite patterns since we have new folks here and people said, you know, I'm new to day trading or I've never done day trading before. Could you tell me exactly what it is you do? And it's not the only way, but it's my way. And I'm going to go over some share sizing and some favorite patterns, some trade examples. I had the member questions there twice. I moved it to the top. And then we got a YouTube channel and a 30-day trial offer we've got out there. All right, some of the questions included, you know, what are your criteria and considerations for using each of your, you know, chart patterns, I call them settings, or even the settings, you know, about why using a 3 exponential and why using an 8 or a 17, why don't you use a 20 simple, or yada yada. I'll go over what the rationale that I used. Doesn't mean that you have to do it, just tell you the rationale, maybe you can take some consideration. And somebody said, you know, I talked about a continuation pattern and a measured move. I want to make sure we cover that. How far above or below the pattern do you use for an entry? And do you wait for a candle complete before entering or exiting a trade? Discuss each indicator and how you use them. Okay. How do you choose swing levels? That's one thing that I do here. It really started big on in day trading on the futures, but it also applies to, and I didn't really realize that it was swing levels, but now we've done futures, you know, it does apply to day trading as well in the stocks. And what are some of my considerations for, you know, the instrument? Do I use futures? Do I use options? Do I use the stock straight up? Is there a problem or any considerations on time of day, size, target stops, the whole 9 yards? And then which time frames do I use? All right, let's start with the chart settings I use. I use 3, 8, and 17 EMAs on all intraday charts and the daily. I will look at the 50, 100, and 200 simple moving averages on daily charts. And I look at daily charts even though I'm day trading. It's because I want to look and see where there's support, where there's resistance, and potential target areas. It should kind of make sense. One thing that I do put on there, I do put the volume profile out there. You can see that. And this is on Thinkorswim. That's the chart that I'm using right there. All right. One thing that I didn't cover right here, but I use the stochastics RSI to help judge momentum. When I'm trading futures and NinjaTrader, I have access to different types of charts and different kinds of momentum indicators. Unfortunately, they don't have a very good stochastics RSI indicator in NinjaTrader for NinjaTrader 8. They had one that was a third-party add-on, and when they went to NinjaTrader 8, they had their own stochastics RSI, but it doesn't work the same. It's not very good, to be honest with you. So I tend to use Thinkorswim charts for trading stocks, day trading. All right, some of my favorite patterns out there. I'm going to go over just a few of them, and then I'm going to go in and there's basically another an entire set of charts that one could use and how patterns form and the like. But these are really the big ones, combined with some of the others like dojis and stuff like that. I use a J-hook. I use a pop out of the box, or a breakout or breakdown, so a pop out or a poop out of the box, and a continuation move, either up or down. I'm going to go over those. This J-hook or zigzag. Don't get concerned the fact that you're looking at futures charts on the background. Those are the best examples that I have at the moment, um, and they have certain things. They've got, the candles. These are Unirinco candles, but they're candles nonetheless. And you go up and down, and then basically a zigzag is nothing more than a move up and a pull back, usually to a support level, and then a reversal back up. For me, the time to purchase it and go long is above on the reversal, and with first target being a retest, and I'll show you how that is, and then potentially a breakout. So I've already got a couple of targets by looking at that. So the real pattern here, and in the volume and the squeeze pattern that I have to judge momentum. And whoops, what you've got here, whoops, let me go, all right, there we go. It jumped around on me. And this is a momentum indicator, and you notice how it was going up, and as the stock started to pull back, the momentum started to wane, and then as the stock reversed back upwards, the momentum indicator goes higher. Whether that's an R squeeze on NinjaTrader or using stochastics RSI, it's roughly the same. It's an idea to judge momentum. Okay, there's the inverted J hook. That's basically the opposite. For every rise, there's basically a fall, and what it is it drops. Now I have an ebook here. Well, I'll go ahead and post that out. Now these were written for futures traders, but the concept and the words that go with them are very, very important. They're also applicable to both stocks and futures. And what I'll do is I'll talk about, keeping the chart clean. Make it as clean as possible. Don't have any unnecessary indicators or anything else cluttering your chart. If you're not using it at the top of your usage list, get rid of it. And in choosing your time frames and how to do that, primarily time-based charts on day trading of stocks, and range-based charts I found best on trading stocks versus futures. All right, this talks about the different kinds of charts that one could have, and talked about the moving averages, talk about an R squeeze, but this R squeeze is a momentum indicator, and I can talk more about stochastics RSI. And for the members, I'm going to do a stochastics RSI presentation, and it's extremely, I think it's extremely enlightening and helps you improve on your performance. I'll give you a glimpse of it today. When we talk about swing levels, there's trader pivots inside futures. There are within other large cap stocks and indexes on the stock side, but not necessarily. We talk about the zigzag and pop out of the box. And let's see. And you can see here on the zigzag, I talk about it being my, what it does, and I look for the pattern, and then I go into a little bit of an explanation. And I talk about the measured move concept. We'll make sure we go over that in great detail here, because let's go back up one. A lot of times, not always, but a lot of the times, if we get a move above, say, the breakout levels, and we get a move about this order of magnitude, so many points, dollars, whatever, the next move up will be approximately the same distance. You can use that as a measuring tool to help you judge how far it's going to run and where you can put your targets. Now, it works really well on large cap stocks and futures, and a little bit less so when it comes to stocks. But it does work as well. And what I do is I look for that and say, okay, well, if that's a measure move, what's over to the left? Is there an area of congestion? Is there a area of resistance off to the left? And again, the inverted J hook is just the opposite. And a lot of times, especially this is at futures, you'll see that if it drops through a support level, it will go back up to that support level, retest it, and then roll back over. And that's perfect. You'd like to see the what I call a zigzag instead of the J hook, was that it went down through the level. And we're not talking about the weak markets, the super weak markets that we've had. We get very few bounces, but this one's a controlled one. It goes up, it reverts to the mean, and then it rolls over. Here lately, the bounces have been really horrific. They've been of larger magnitude. Okay. All right, the pop out of the box. The pop out of the box is just some sort of consolidation area. In this case, it's kind of like a cup and handle in there, but the pop out of the box can be a lot of different things. Let's see about if I've got one in the drop out of the box here. There's your inverted zigzag, pop out of the box. And this is a drop out of the box. And here we've got one that is very, very tight consolidation. Much more defined, or better defined, than this one in that example that we had in the pop out of the box. And they happen all the time. So you watch for the consolidation. This one can go either way, but it normally goes as a continuation in the same direction. All right, and then you can pick up your targets for swing levels, below or above. All right, and we'll go over the bullish continuation here in just a second. All right, and here's some stock example of bullish continuation. Basically, it's a 3-candle pattern. In this case, bullish, it's a green candle, a red candle of approximately the same order of magnitude, then followed by another green candle that is at least as large as the red and negates it. And the buy point for the continuation would be on a break above this third candle, that 3-candle pattern, and the stop is somewhere below that continuation. So if it goes up like this and then rolls back over, that pattern's not working that you expected. Don't stay in it. If it goes up here and it comes right back, you could get it doing a consolidation, but it's not a continuation pattern. If you want to stay with it because you think that it's going to hold that level, fine. And that's where I judge using the momentum indicators below. All right. Let's go up here. And in case this was Twitter today, went long around 3150. Let me double check that, Raj. Okay, 1 second. See if it works for me. I get open. Well, it opens fine for me. I want to ask one thing. You may not have pop-ups allowed using your browser, and you could have a security setting. Check both of those, because either one of those can cause you an error message. It is coming up here. Other people, see if you can see it as well. All right, so what we did, you're welcome. And if you can't, we'll find another way to get it to you. All right, so with this continuation pattern, again, this was a 5-minute chart. Go long above with a stop below, approximately 50 cents. And then I'll talk about possible targets in just a second and stops. But basically, my stop would have been below this continuation pattern. Why? Because if it goes up like this and then comes all the way back, do I need to let it go down to $30 to realize that the bullish continuation pattern is not working? No. If that pattern that I was looking for, a continuation pattern, was the why I was getting in, if it goes back down to here, it is not a bullish continuation any longer. It may resolve itself to the upside, but it's not this pattern here. That's why I got in. So if that's the case, if that fails, it's not doing what you expect, get out of Dodge. Learn to live to fight another day. All right. Now, I don't know whether this is a good time to cover targets or whatever. We've got a trade example of these later, and let me go over those then, not now, as far as targets and moving stops and the like. All right, some trading rules. I'm going to inject those right now. And that is the power of quitting. Consider it nice if you meet or exceed your daily goal. Quit. The longer, like being at the casino, they want you to stay at the table and keep gambling or trading. The longer you stay at the table, the more likely it is that they're going to get your money. If you meet or exceed your daily goal, whatever you decided that is, quit. Go find something else to do that day. If you exceed your maximum daily loss limit, quit. You need to preserve your capital. Keep the powder dry. And make sure you have money in your trading account to live to fight another day. If you lose X number of trades in a row, it could be 3, it could be 5, it could be a dollar amount. But if you lose a maximum number of trades that you've determined with your experience, and it could be anywhere between 3 to 5. If you lose 3 to 5 trades in a row, primarily in the futures, quit. Multiple losses indicate you're out of sync with the markets. Now, will that apply possibly to day trades as well? Yes. If you make a number of entries and you're not making money, now you could have two losers and one winner, and one winner and 2 losers. Okay, you're getting some winners in there, so you're doing something right. But I'm talking about multiple losses in a row. Trust me, that's saved my bacon a lot of times. These rules are out there to maximize your gains and to minimize your losses, because managing the risk and managing your emotions is what's going to make you a successful trader. And now talking about risk. How much should we take on? Well, it depends on your account size. A lot of people talk about, oh, well, I don't want to risk no more than 1% or 2% in a trade or whatever. Well, with a small account, that's probably not going to happen. Small account, you need to make sure that you're not putting all your eggs in one basket. You need to make sure if you've only got a $10,000 account, you don't have $8,000 in one trade if you can help it. You may have to when you're smaller. As you get larger and larger account size, that should go down. And I'll show you how, with a share sizing chart, that you're not really risking $8,000 if you put $8,000 in a trade, because you're not going to let it go to zero. All right. Reward to risk. It's important that there be a reward, and that reward has to be larger than the risk. That's the best kind of trade. Having them equal to one another, you don't have an edge. And the unintended consequences of taking on too much risk is that you get nervous. If you find yourself getting, I'll say, extra nervous, you ought to be a little bit nervous every time you trade. If you get nervous in the trade and you exit early, that's probably you're taking on too much risk for your risk tolerance. Everybody is different. Some people, they have no qualms whatsoever letting money just go by the wayside. It doesn't matter. They take on a trade, they let it go, and it is what it is. Usually, those are the most successful traders. That's why they've ended up being like that. But it's because they are successful and they're good, not because they have no nerves. If you are taking on too much risk, you will probably exit early and you will not let your winner run. And if you exit early and don't let your winners run, then you're going to get into the situation where you have more large losers and small winners. The magnitude, the amount, of return that you're getting is going to exceed. Even if you had 3 winners, but they're all small, you have one big loser, and it wipes out all those 3, 4, or 5 winners. Okay, let's move on. All right, share sizing. How many should I buy? Well, there are a lot of methods out there, but I'm going to show you one that I use. I've got a spreadsheet, little table that I'm going to show you and I'm going to give you that is plastered up stuck on the wall above my trading computer monitor. And I glance at it all the time when I'm entering. And I do the mental gymnastics. And I use a $100 table, but I've got a $200 here table. It doesn't really matter. Now I'm going to go over an example where I'm going to do an entry at $13.50. Now you'll notice I'm doing this risk and everything is going to be in dollar amounts. I don't believe in doing percentages, personally. I know other people who do use percentages and whatever, but especially from a day trading perspective, I don't think that that's the most effective way to do it. All right, we're going to have an entry of $13.50. We're going to have a stop of 13 and a quarter. Yeah, it looks tight. It possibly could be. But in this case, that's what we have as our example. It's 25-cent stop. I'm going to calculate the difference between those two as being 25 cents. I'm going to divide the maximum risk per trade that I'm going to allow myself to have in the trade, and say in this case 200, by the risk per share calculation that we had before, and then it would tell me how many shares that I'm allowed to buy up to that amount. Now, if we've got high volatility, I have the option to reduce this. I don't have the option to exceed that number because my maximum amount that I wanted to have at risk is defined by the $200 amount and how much the stop is. So I cannot exceed 800, but I can go lower. I can go down to 600 or 400. All right. And, oh, by the way, there are quite a few times where I look at an entry, a stop, look at the calculation and realize that it's not going to be enough for me to make any money. So I move on to the next trade. All right. You can use the calculator, or you do like I do and use a lookup table. Now, this is an example of a $200 amount, but I'm going to give you one for 100 because you can always multiply it. So if I had 100 and I went over there to I go read down to the risk amount, read across to the value that you want, and here's 200, and then you look up to the top and it tells you how many shares you can purchase, up to. Well, if I only wanted to risk $100 and it was the same, there's 25 cents. There's 100 here. Whoops. Look down to 25, over to 100, and up to 400. And if I was going to risk up to $300 on this trade, I would multiply that by 3. That'd be 1,200. Okay. Let's go to the next slide. So while we're at it, I am going to go ahead and see if I've got the $100 risk share sizing here, and I'll post it. All right. There's a PDF of it, and getting it. And here's one for 200, and it's in Excel. Let me make sure this is working. And open. You're welcome, Valerie. All right, and all you'd have to do over here is potentially, oh, there's 200. All you have to do is just change the shading, enable editing, change shading, and it works. Okay, works for me. All right. All right. Okay, back to the presentation. All right, here we got some trade examples. I've gone pretty fast. I've only been talking about 25 minutes. And I've covered a lot of concepts. Well, let's take some examples in real life. These examples are trades that we've had in this room in the last week. I love earnings season. And I have a whole presentation on how trading gaps. And if we have time this afternoon, I'm going to go ahead and go to that. But I'll finish this presentation, see if there's any questions you have. And if we have any time left over, I'll show you how I trade gaps, which is really how do I trade earnings. But I'm going to tell you a little bit about it right now. Okay. What we have going on here. We had a stock that gapped up, Philip Morris. I went and looked at the daily chart, and $86 was a daily level that was basically a resistance level. So I knew that when it would gap up to there, and in the first 5 minutes was going to tell me whether it was going to go higher in the day or it's going to roll over and poop out. Well, it ran up, and this here is a 5-minute chart, but I was looking at a 2-minute chart because a lot of times in earnings, they move quite a bit. And so therefore we went long at this 86.53 or something like that. So it was, I'll call it 86.50. I don't even remember what the number was, but it was a little over that. And then the stop we placed down on a 2-minute chart based on the low. It came down to this level, and we had 200 shares at the beginning because of the difference in the stop. As it hit this breakout level on the 5, in that green level, we added on. That's an advanced concept of adding on 200 shares or some number of shares. There we doubled it, but moving the stop up. So what we did is we tightened the stop. We added more shares. So we now had 400 shares. And the stop was only 50 cents. So it was the same or equal. Actually, it had to be less. Because if it was the same, I can't add on. Unless I had taken less than a full load of shares. All right, so as it rises, we start to raise our stop, trailing stop. These little green dots you see here are what I use as a average true range chandelier stop, ATR, average true range, and it looks at the average true range of each of these candles, and it moves the stop up based upon how the stock is reacting. As it goes up faster, it raises the average true range dot. As it levels off, it basically levels off, and in fact, they can actually go down. This is only a nominated or notional stop. For me, I use that as a guideline, not as an absolute. And if I'm coming up here and it's starting to get a little toppy here, they're saying that it could pull back to below 88 and still be bullish. Yes, it can. As I'm getting up to here, I'm probably going to tighten it closer and closer to the price and not all the way back down. I'm not going to continue with a 50-cent trailer. If you want to do it differently, so be it. I can't say that you're wrong. The fact is that anytime I get inside the average true range dots, the ATR dot, I'm setting a higher probability that I'll get taken out by a spike down and then it'll continue to go higher. Well, we established our targets based upon the calculations that you saw before. We had, in this case, we had 400 shares. All right. So with 400 shares, I'm looking at multiples of risk. I can do 1 times, 2 times risk, 3, and 4 or more. All right. Now, what I'm trying to say here is that if I'm risking 50 cents and I entered at 86.50, so when I get to a plus 50, I'm 1 times my risk. And more than likely, I'm going to raise my stop to break even when I hit that one, that target up here. My stop is probably right here at break even plus. Well, I don't normally like to take 1 times risk with stock trades. With futures, that doesn't work too bad. But with the stock trade, what I normally try to shoot for is double. And so in this case, it'd be $1. And if we entered at 86.50, I'm looking for 87.50. Well, in fact, it was still moving so fast on the 2-minute that I judged that it was going to get higher, and we took it to 88. So we ended up with $1.50 on that first 200 shares in the bank. And that equals, we had 300. And when we hit that target, our stop is 87 something. We're playing with house money now. Unless we got a horrific fill, we're not going to lose. We can't lose on this trade, and I love it when we get to that level. And then what I'm doing is I'm trying to say, well, how much can I squeeze out of this one? Can I get to 3? Can I get to 4? Well, where's 3 times? That's $1.50 on top of what is 86.50. In fact, 87.50, 88. That's 3 times, 4 times. Now we're starting to get into the numbers that it's really hard to get much above 4 times your risk. When I hit a 4 times, and in this case, 4 times 50 is $2. When I get a $2 winner, I'm trying to take at least 3/4, if not 100% of it off. If I see weakness, boom, I'm out. Well, in this case, I saw some weakness, and we went ahead and took, at least I took, and I told people what I was doing is that at 88.50, I had $2 in the trade, I had 4 times risk, and I had a 3 times risk. So in overall, I had an overall average of 3.5 times the risk. All right, so we had $300. Sorry, but it's hard to draw with a mouse. I tried getting a pencil, it didn't work any better. Plus $300. Okay. Now on the other one, we had $2 on top of that. So we had $400 on the back half, the last 200, for a grand total of $700. And in $700, and we risked 400 shares at 50 cents. So we risked 200. And then where you can see that is the zeros cancel out. 7 by 3 divided by 2 is 3.5. All right. And that is an excellent trade. Anywhere where you average 2 to 3 is very good, and 3.5 and higher is absolutely excellent. All right. But that's our goal, because we could have gotten a loser on this one. All right. Let's move on to the next example. Next example was PetMed Express, pets. I'm going to show you what happened here. At the open, it gapped up. Now we're looking at the dailies as well, and it gapped up over 31. I thought, oh, that's pretty good. But then it immediately gave it up. And it pulled down to a level and started to stabilize. And some people will say, well, it's just letting the 8 catch up with itself. Well, I don't know if it's the 8 catching up with price, but what it is buyers said, I'm not letting it go below 29.5. Well, we let it rise a little bit because this could be a bear flag. A bear flag down like that and then a rise like that. I need to be proven to myself that it's not just a bear flag, that it's actually a dip, and this happens quite often, and then it'll rise at least back to where we were at the open. And that's what I was counting on. And I told people what I was doing in the room. I'm going to reiterate. This room does not provide recommendations. I tell you what I'm doing. If you ask me what I would do if you present me with a question, I'll tell you. I'm not providing advice. All this is trying to teach you how to trade and make you it educates you and answer the questions, but it's up to you to decide what there are. So people who are looking for following of me and whatever, that's probably not a good idea, because the market's going to move pretty fast and you have to make up your own mind. Your risk tolerance may be different than mine. You may be more, maybe less. Well, let's just go over the examples that we had. It got up over the $30 level, $30.25 roughly, and I got a fill at $30.33. All right, and I established this at about what? That's 30 cents plus another 30. That's 60 cents. So we have a stop of 60 cents, and we have. Let's go back up. Let's look at our share sizing. If we had 60 cents that we wanted to risk, maximum of, we don't want to risk anything. 60 cents is what the calculation came up with. And if I wanted to risk no more than $250, in this case $240, I come up with 400 shares. I can risk up to $240 with 400. That's what we took. All right, so we got 400 shares, stop 60 cents, 240 at risk. Where's target number one going to be roughly? Well, I told you a lot of times stocks will come back up and retest the opening high. Well, we got to 31.33, $1 in, just a little bit less than 2 to 1, but I started seeing a little bit of weakness when it got up here, and then it went back up, and then it started to wobble the second time. I said, you know what? I'm going to take at least a little bit off the table. It's a little bit less than 2 to 1, but that means that I would have to go that much below. I could give it some room here if I took 200 off the table. So I like to get money in the bank as soon as practical. That's not as soon as possible, but as soon as I can get at or near my 2 to 1 reward to risk. And that's what we did. And then now it's a matter of managing the trade to see how much we can milk out of it. Once you do that, you're kind of in gravy. All right, so we went up, and you notice how it's kind of riding the 3 exponential on a closing basis, but nowhere in there did it get below the 8. It started to kind of peter out here, and you notice how in stochastics RSI and the volumes, it's starting to go down. I've got price going up, and I have divergent momentum going lower. what's happening here is it's starting to level off. It's running out of steam on this move. It doesn't mean that it's not going to go to $35 to $40. It's just probably not going to do it in this move. And we've got $2 in the bank ourselves, actually $2.50, from $30.33 to $32.83, $2.50. It's $500. All right, and we took $1 times 2 on that one, the first half. That's a pretty decent trade. Again, another $700. Just happened to be magic numbers. But we had $700 on 400 shares, 3.5 to 1. These were in consecutive days. Right. Notice this was at a 3-minute chart. I like to use smaller numbers to start with. Then when I start to get further into the day, I'll move to a higher time frame. I'll move to a 5-minute. And then as I get later and later in the morning, 10:15 to 10:30 or so, I will go to look at the 15-minute chart to see if I can get some setups or to judge the longer term trend. And we'll show you some of those. All right. This was on 7/19. Oh, there's a, never mind. That's what it's reporting. The other example the other day was Skechers. It gapped up. Now this is a 2-minute chart. Thanks, soccer. And it started to break out here. And we chose looking at a 1-minute chart, there was a 50% number, long at 30.53, above the body here of that candle. As it went through the second time, I guess the first time here, and it did pull back, and it got close to us. And our stop is under 30. I don't put it around numbers. If you notice, I won't use multiples of 25. I won't go long or put stops at 0, 0, 0.25, 0.50, or 0.75. They'll always be a little bit off of them. Why? You watch on the matrix of where the orders are in, you're going to find a lot of the algorithms will be right on those numbers. They're round numbers. Well, 25 is not round. It is in stock speak. All right, so in this case, let's see how we did here. Even if you didn't drill down to a 1-minute candle or you kept it on a 2, would something like this $30 level, $29.97, this $30 level, about 50 to 55 cents, would that be okay? Why would that be a stop? Why would I not put it underneath this other candle? Well, let me draw up a hypothetical. If this was the body and it went up and it went up and then it comes back down, do I need to let it get all the way down to here to realize that it's not working? My idea is yes, I do not have to let it get all the way down there. If it, instead of going up, if it had turned over, this black candle had gone lower and lower and lower, I don't need to let it get to $29.75 to realize that I'm wrong. All I want to do in my mind is I want to find out what kind of chart pattern will tell me, excellent soccer, will tell me when I'm wrong. And if I see it, I get out. I don't even think about it. So that's what I'm thinking about. I'm thinking about where do I take my money and where am I wrong? And those are just tripwires. So when I hit them, I do it. I become a machine. You don't have to think about it. You don't want to think about it. You're doing the calculations. It's all about the odds. All right, so here we go again. 30.53. We got to 31.28. That's 75 cents. I took money off the table because it looked like it was not going to run. Momentums. Those are the average true range, TJ. And they're this is in TC2000. I can show you how to do that and give you a pointer on that. Do you have TC2000? If not, there are a number of ways to come up with average true range. Do you have Thinkorswim, or do you have Ninja Trader? Okay, I can give you even better one on Ninja. Okay, here we go, or at least point you in the right direction. Now, here we go. This would start up there, and I said, you know what? 0.75 is a little about 1.25 times risk. It isn't 2, but it's greater than 1. Do you have Ninja Trader 8 or 7? That'll be a biggie as well. And you notice how it started leveling off here? And I'm okay, great. So I'm raising my stop up here, pretty much following the 8 exponential. The average true range, it flattened off. This is called a chandelier stop, based on the parameters that I put under for average true range and the following. Because the stock flattened out, so did it. Well, I don't necessarily want to do that. I don't want to have my stop all the way down below my entry. If it gets up here, let's say that that didn't happen. What if it got up to here and instead of going higher, it started to roll over? Do I need it to go all the way back down to here for me to be proven wrong? No. Again, in my mind, I'm figuring, what picture am I going to see? I'm going to see something that's pretty close to that 8 exponential moving average. Not exactly. I'm going to use it. I'll average it out into somewhere around in here based upon the technicals they support. Basically, it was basically break even. And as we started to climb, I started to raise it some more. And this thing started to look, and what you're not seeing here for this simplicity of the chart, the momentums were actually waning. And it was giving me an indication, a warning, a heads up, that price was going up, but the momentum was going down. Now that's okay as long as the momentum curls back up fairly quickly. But if it keeps going lower and lower and lower, you're going to get a negative reaction pretty soon. And as sure enough, we got one not 50 cents higher, 40 cents higher than what we got out in the first one. So we got $1.10 and 75 cents. We didn't get the big winner. It did not run. The markets were keeping it from doing it, and whatever, buyers just weren't stepping up that much. Maybe it could have been the fact that it gapped up from $26 to almost $30, and it had to digest that. I don't know. I don't really care. Yep, we'll be happy to do that, NB. I could be a turkey and said, I'll do that after you join. But I'll make an offer in just a second. Now, well, I think there was a little bit of a different part of the presentation. Hold on one second. Let me... Let me bring up the PowerPoint. I believe I'm missing a slide. Maybe not. I want to make sure I cover all the concepts. Share sizing, trade examples. Question. Nope, we got it. All right. What I'm going to do now is I'm going to open up for questions that you have from the peanut gallery. Now, the business about average true range and whatever, how about if I get that at the back end? All right, so let's All right. Now, anybody have any questions on or comments on what we're doing here? I'd be happy to answer anything. I'll look and see if anybody's actually typing them in. Oh, I see a couple. Hey, Pablo. I sure appreciate it. Now, you're talking about volatility stop, Jonathan? That's what the ATR stop is, really. They're all based upon volatility, and the average true range is the way you judge the volatility. I just call it an ATR stop. It's a volatility stop. All right, let me go into some of the backups real quick. Hey, Moto. I'll buy shares, I'll buy options, I'll buy futures. Any of them, anything that makes me money. Now, a lot of times if we're between earnings seasons, there are not a lot of gappers with movements. And here's what I'm going to talk about: your gappers, the movers, and how I get these to move. Why do stocks gap? There's got to usually be some sort of, and I'm not ignoring you, NB or Susan. I'm really answering your question. Why do stocks gap? Because usually there's some report. There is usually earnings, conference call. They have a new, an unscheduled event would be something like they've got a new product, they got a new contract award, something that's going to roll right to the bottom line. Those are the ones that are going to cause the most amount of movement. Ones that are surprises. And that will get people to react on emotions rather than logic or in addition to logic. All right. I like to trade gaps because they're usually often the beginning of a major move or a reversal. Gap up, gap down. They can be very profitable at very the short term, but also you can do a day trade to a swing trade, or even do a swing trade if you missed it on the day. I want to say, Sue, that's a good question. A lot of it depends on your risk. To me, if I'm going to day trade them, I'm going to get them fairly close to the money, just a little bit into the money, somewhere between 55 to 65 on the delta, and I'm going to buy 1 to 2 weeks out. And that's it. I don't need to be paid a whole more because I'm not going to hang on to them. They're either going to move or they're not going to move. But I need to give it a little bit of time that it's buying, not because I'm going to hang on to it, but because others will buy it from me. They need time for it to make money too. They won't be motivated if it's going to run out tomorrow. So I'm probably going to use at least 1 to 2 weeks out, maybe a little bit higher. All right, all good up gaps are not good shorts. A lot of people want to immediately fade the gap up. I'll tell you how that's not such a good idea in a minute, how to judge which are. All down gaps are not good longs. Some are. Most are probably not. Not all gaps are filled, at least in the near term. A gap in the opposite direction of the recent price movement will create a shock value that we're going to exploit. All right. If it's gapping up to a support or resistance area, that's why I use the daily charts. That's why I use hourly charts. Look and see where support levels are. If it's going to gap up in the pre-market to that support level, I mark it on my chart. I put it at the top of my list and I watch it like a hawk. That's why we knew Twitter was going to move today. That's why we looked at Xilinx. That's why we looked at Tesla, but we didn't get into Tesla. And I'm trying to remember, there was another one, but it escapes me at the moment. Anyway, that's how we do a little bit of homework beforehand. Somewhere between 8:30 9 o'clock in the morning. That's what we would look at. Boy, I love I love those that report in the afternoon. You know, I'm not going to trade it, but at least I give a slow chance that overnight I can look at the charts, mark them up, and put them on my watch list. And I can know where the resistance level is for a gap up. Yeah, love. Thank you, Jonathan. That's right. And we thank Stalker for that one. All right. And here's one that's really things that I got to look at. What's the overall market doing? If the market's gapping down quite a bit and it's gapping down, is it gapping down because the market and it's following the market? Or is it extra? It has to be relative. Now, I like the fact if the gap is up or down and the stock is doing the opposite of the market, then you know it's the stock. All right. Is it in favor, out of favor? Right now, everything's out of favor. And does it have high short interest? And let me type this in here for you. Shortsqueeze.com. Now, yesterday, shortsqueeze.com was so hammered that it couldn't respond. The server was overloaded. But you can find out as a percentage, not numbers of days, but the percentage of the float. So percent of float short. That's the key number. Percent of float short. If it has a high number, like over 10%, it has a pretty good chance if it's that much short and it gaps up against the recent trend down, that this thing could run like a scalded dog. All right, let's come on over here. Get back to the presentation. Let me propose something to you. What if you were a hedge fund manager guy, portfolio manager, and you suddenly with this, you were short, and suddenly they have earnings and it's a lot different than you thought. It went the opposite here. What do you think their boss's reaction is going to be? They're going to come over and say, "Hey, you got 300,000 shares of this short. What are you going to do about it, dude?" Yeah, they're going to feel the pressure. They're going to feel the heat. And guess what they're going to do as their stops? They're going to have graduated stops at resistance levels. So if you had a resistance level of 30, they're probably going to have $30.20 as a buy point, and some more shares at 30.50, and then some more shares at 30.75, and some more shares at 31. They're not going to go all out because they've got a gazillion shares to dump. All right. So we can watch how we get a short covering rally. All right. We've already talked about the setups, how to scan them. Your broker will probably have some sort of list. We have a scanning list here, a scanning program here that I use. It's not ready for prime time for use right now. We're still debugging it, but at some point it'll be available to the public for purchase. I use briefing.com, and then I skinny those out. I use Telechart 2000 to weed out the very small stocks, ones that are under $5. I'm not interested. Maybe the ones that are over $300 to $500. I'm probably not going to be interested because it's just going to be too expensive to buy the stock, and it might even be too expensive to buy the options. Now, what else? I'm going to get ones that have pretty good volume on a normal basis. And so I could probably take 100 stocks that are being reporting earnings today, and there's probably only 50 of them that I'll really be interested in. And I put that in my list, and there it is right there. And it's on a watch list, and I sort it, and I start running through the list, and hook up the charts. Whoops! What happened? Okay, they all went blank for a second. You guys still hear me? I sure hope. I have no earthly idea what happened there. Let's get back our presentation. All right, here we go. All right, cool. Trade management going to be the same as we did before. Good entry. You got profit potential. If you have a bad entry, like you try to fade it and it starts to run the other way on a short squeeze, you can get run out of Dodge in a hurry. All All right, let's go over that. Some considerations. Whoops, I'm going the wrong way. There's the gap list I talked about. Types of gaps. Reversal against the trend. This one was telling me the day before earnings, they had a big run up. The odds are if you have big run ups the day before, even if they come up with good earnings, it's going to gap the other way. This is usually chumming the waters. If anybody's a fisherman, you're going to get the people to bite, and then you're going to slice their head off. Selling opportunity. Earnings, conference call, gap way up, doji opens lower. Even though it rallied, yeah, profit taking. The smart money selling to the dumb money, and they're getting out of Dodge. Gapping over or under prior swing levels. I've got them marked. I marked them, and there's a prior swing level at around 111. It opened at 111, and it's kept running. Smuckers. It ran to where? It ran to the next swing level. This was a gap. Not exactly all the way. The gap was from about 113. But we were able to get in early, watch it run, and this is on a, what kind of basis? This may be on a daily basis. Yeah, it's a daily. Well, it went right up here. Was it going to continue to go? Probably not. It made it on one. But what can you do? Put this on a watch list. It gets back up over 117. It can run to 122. That's how you can take a day trade, excuse me, and flip it maybe into a swing. There's Dollar Tree. 2-year daily. Gap up and then run. This is running on dailies. There's nothing day trade about it. It's a day trade would be right in here, but afterwards you could look at it so that people say, well, Steve, is this only about day trading? Well, not for me. It's about trading short term. So it's very short term. It could be a swing trade. It could be an intraday trade. I tend to want intraday trades. I tend not. Oil. We throw oil, especially on Wednesdays, to report. There are some other times in there that we do, but not on a general basis. On Wednesdays, we always try to trade a report. Gap under consolidation. Well, this one, it was up in here, 19, and it gaps down to below 17. Which way did it go? It ran to the next level. It ran all the way down to 14 and a half. You could see that happening. By knowing what's going to happen on daily, you can then say, okay, I'm looking for an opportunity to get in to this stock to the short side, SPN. I'm looking now when I see the gap early in the day. Let me get my recording. Get my crayons here. Early in the day when we saw it open here, there has to be some sort of intraday reaction that I want to be looking for. Right in here, rallies are to be sold. Give me an entry. That's all we're looking for. Okay. 5-minute opening range. Here's how to keep you on the right side of the trade. I don't trade ES because it's $12.50 a tick. I trade Dow, less volatile, NASDAQ, pretty darn volatile right now, but if I want a little more action, and crude oil. You can trade the Russell, but the Russell has been misbehaving for the most of this year. So really, NASDAQ and Dow, and in stocks. Okay, 5-minute opening range. Help keep you on the right side of the trade here. Let's get a good color here that will contrast. Come on. Color. Green. Color. Oh, yeah. All right, this was a 5-minute chart. It opened at 57, closed all the way down at the first 5 minutes to 54. Then it ran up to about 55. Well, how come you didn't go long, Steve? Well, some people will say don't go long until it gets above the bar. The safest way to do it is have either a 2-minute opening range or a 5-minute opening range, some number, and make it get over the body and then a little bit. And you don't go long unless it gets above there. That's the quote safest. Now, when I say quote safest, that you're all that run from 54 to 57, that $3 could be your profit. It could go all the way up there and then tip its nose on the other side and then crap out on you. Well, you don't look so smart there when your stop is at 56 and you lose $1 a share. So it's not always the safest, but it does make the stock prove that it wants to go higher. I'll use a 2-minute or a 5-minute opening range, and I want it to get above the body. And when it gets above the body, it's going to tell me that it's ready to run. Now, in this case, it went down and it did the bear flag. How can you tell that? It's got to be 1, experience, and number 2, probably looking at the momentums that you don't see here, and that you're also looking at smaller time frame. So the 2-minute time could have been down, 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 bounce, bounce, weaky, and then down. So what this did internally, looking at a smaller time frame, is it went down, it bounced back up to 55, and it rolled over. That's what it looked like. And in your brain, you've got to look at this and interpret what the smaller time frame is looking like, or look at a smaller time frame and anticipate it. At what level does it have to get up above before this becomes your target at 57? Probably a third of the way up, maybe halfway of that body. Simplest way is go look at a lower time frame and the momentum. All right, SIG, gap and crap. It gapped up to $100. It didn't follow through and pulled back. Went all the way back down to 90, which is back about where it started the day before. 5-minute opening range. SIG, that same chart we were looking at before. Where did it get to? It got as high as 101, but the body was right here. And if your stop was above the body, somewhere into the candle, you'll have to, it's a judgment call. It had no follow through. At best, even if you got triggered in, you know that you weren't going to stay below this level here, or maybe even less, or be higher. Your stop, if you got long there, is probably halfway. It's probably that prior candle. So if it doesn't continue up in this direction, get out. All it's going to cost you really is your commissions. If it then pulls back and goes back up again, you can always get back in. If it came back down to here and then started to explode higher and got up to a better level, you could always get back in. All the above, Dave, NB, pre-market and at the open. Now, let me show you. All right, let's go to my live trading event. Okay, you see these right here? These are running for the pre-market. The pre-market, I'm looking on Thinkorswim, but this is our homegrown scanner, and it is really good now. It has a couple of bugs in it we're trying to work out, but very soon it's going to be released to the public. We'll let you know. This thing will allow me to see stocks that are going up, and this right now is scanning against only my list of my watch list, my earnings watch list. That's all it's looking at. I don't want to look at the whole market because it's going to be a gazillion symbols that I can't follow. And I qualify them for price. I call it as an overall volume, and then there's a volume multiplier over here. This one right here at 6.2 was doing 6.2 times normal volume for this time of day. Those are the ones that I want to try to find. And it gives me an idea to look at. You're welcome, Ram. All right, let's go look here. There's a 15-minute chart, did a J hook. It gapped down. Look what happened to Dollar Tree. Gapped down to 72.50. Well, here somebody faded the gap, and it worked. Is the right place to fade the gap down here at 72.50 at the open? Well, this is a 15-minute chart. It rose up here, and then it fell back to about the 50% level, then started curling up. I can tell you, the way I'm going to play that one, so I'm going to let it come up, I'm going to let it go down, and I'm probably going to think about trying to go long above, I'll call that 74 and a quarter, and my stop's probably going to be 73.75. 50 cents. You see 50 cents all over the place in my book. And where am I looking for my first target? 75. That's 75 cents up. That's about 1.5 times. Okay, that's the first target. It got there, and it had trouble getting there. Eventually, it got up to the prior day high of 76. You have to see these. You have to do it a lot to be able to know when can I go long, when can I fade the gap. But the stock's going to tell you. The chart will tell you. Here's the weekly on Dollar Tree. There was Dollar Tree on a 15. There's Dollar Tree on a weekly. This was what we were talking about. It was consolidation here. Once it went above 80 something, it was off to the races. Now, that's how we get follow through, because I showed you the 15-minute chart where it gapped down. It gapped down, and then it started running. And then, actually, yeah, that's right. Okay. Barry, 45-degree runner. This is on a daily chart. Okay. When it gets above 27, it's time to buy. That could have been on this chart here. That was the earnings day. Huge volume. But the next day it gapped up. As long as it holds 5-minute or 15-minute opening range, you can go swing trade it and swing trade long. All right, let me minimize that puppy. Let me take this down. I am going to, I don't know how or why that thing happened that way. Ninja, ES, Ninja, NAS, whoops, Ninja, NAS, okay, and down. All right, this is, we're kind of evolving it to what people want. Hi, Charlie. You're welcome. But what we're trying to do is we're trying to watch which stocks are moving. Right now we're in earnings season, and that's why I've got it dedicated to that. When we're not in earnings season, we'll move it and change it a bit. And then I'm trying to monitor on a 3-minute, 5-minute, or 15-minute chart what the stocks are doing. And when Xilinx went up, it went up to 79.5, and then it pulled back, and I watched the 15-minute buy over 78.5. Now, we didn't go long because it was at around noon or so, and I had to step aside and make sure I finished up and polished up the slides here. But we could have gone long there. And here's the J hook that happened pre-market for Twitter, because it released its earnings last night. It went up. It pulled back in the pre-market, and the actual open was somewhere around 31.50, and we went long, and then it started to go against us on a 5-minute chart. We got out with a very small gain, say $50 or something like that. Then it started to break out again, and we went long again. Now, unfortunately, I got out at 32.50 because I thought it was done, and it ran 50 cents more. That's okay. I take my half out of the middle. But what we can do is we watch these, and I'll pop it up, and we get to it, or I minimize it. Or if somebody says, hey, this towel's running, let's look at it. Well, we'll go up here and I'll look at towel. And go, whoa, that was pretty good. That's a 15-minute chart. Let's look and see what it did on a 5. Today, 5-minute chart. And there's a 5-minute opening. This is pre-market. There's the open. It ran, and it basically kind of stalled. It had most of its run where? In the first 20 minutes of trade. There's 10. Yeah. Very early. A lot of people will say, oh, the first 30 minutes or 60 minutes amateur hour. Only if you do it wrong. Here's what happens. Most people will jump into a gap inside of the first couple of minutes of the trade, and then it runs against them. What usually happens the first 2 to 5 minutes of the day is that all the pent-up orders from the pre-market are all filled, and then relief. Then the pros take over. And at that 2 to 5 minute level, that's when the real movement's going to take over, the real buyers, the professionals. They're usually just selling to us when we're buying in that first 2 minutes or 5 minutes. So watch it, and that'll keep you out of trouble. All right, let's minimize this puppy. Now, we had a couple of questions. We had questions on average to range. I do still have those. But I want to open up for any other questions, but I want to go back. I want to go back and tell you about, where did it go? Top Gun Trading. 30-day trial for $14. All right, I'll give you the link here. If you guys want to give us a shot, $14, 30 days. Piece of cake. If you can't give up $14 to see what we're all about, I don't understand why you're still doing this. Anyway, I'm being a little bit tongue-in-cheek, but I'm actually being a little truthful. My YouTube channel, I'm going to post things out there. I apologize. I've had some back problems. I have not posted a lot of stuff since the 18th. It's about a week. But we post up our trading sessions. Things on, let's show you right here. Trading sessions are pretty long. They're boring to try to figure out, what is it? But I've got things on gaps in stochastics RSI, gaps and run presentation, a stochastics RSI website. These are all very valuable, and we're not charging you anything for it. You can go ahead and look at them. I'm going to post up trades of the week, trades of the day type of stuff. And I have a bunch of them from the future side when we went over to this side. All right, David. And we'll have the copy of the presentation right here on this website, the YouTube channel. I'd strongly suggest that you subscribe to the channel and come back and view the videos at your leisure when you can. I think it's a good resource. And if you have any comments or questions or want any help, I'm going to give you my email address. topguntrading2@gmail.com. What we've done, Steve, is we've added stocks to the futures. So what you see here is what? There's the S&P, Dow, NASDAQ, and some stocks. No problem, Janice. We knew that would possibly be an issue, short notice type of stuff. We always record them. All right, I want the people to stick around that want the Thinkorswim, I'm going to try that first. Your Ninja Trader might be a bit of an issue. Does ES lead the SPX or vice versa? I think the futures always. Oh, yeah, good question, NB. I'm sorry. I'm in here guaranteed from around 9 o'clock in the morning, on the mic at 9:15, solidly until 11 to 11:30. Usually we'll take a lunch break, sometimes at my desk or not, but I'm usually not transmitting. And then I'll try to be here in the afternoon when I can, but there's no guarantee. Day trading stocks, most of the money is going to be made in the morning. Day trading futures, most of the money is going to be easy money is going to be made in the morning, but you will get movements later in the day. Like we just had a pretty good up move in the futures while we were talking here. I use Renko because it helps me, but sometimes we use 3 minutes, 5 or even 15-minute charts. The problem is, especially with the volatility, to me, I'm a price guy. Now, the ebook will tell you why I like to use Renko charts. Now, let me get, before I forget it, let me find out. You're welcome. We can always have this discussion. I'm limited. All right. Who was looking for the Thinkorswim volatility stop? Okay, and NB, you were looking for Ninja though, right? Or TOS. And if you're working for TOS, do you have the capability of opening a Word document? I've got, well, let me post them both. I've got a Word document and I've got one for Thinkorswim and both Thinkorswim, one's in PDF form and one is, hey Lowell, and one is in a document form. The problem is, copying PDFs don't always work well. All right, who was my Ninja Trader ATR guy? I'm going to need you to private message me your email address so I can get you that. All right, so pop me your email, and I'll be happy to send it to you. All right. Other questions, folks? Now let's see. Karen asks, what price do you put on your bars? How many bars? Well, let me go to YM because that's my preferred instrument. Here's the deal. We have a number of different settings. You won't be able to see this, but I'm going to really kind of talk you through it. There's something wrong with the Omnovia projector that causes you not to be able to see some of my parts of my chart. And in this case, we use 10 Unirenko, 8 or 6. And in this case, I will use, when it's really, really volatile, I'll use 10. Because I want to say, the whole idea for using Renko charts is to see the trend. But on a more normal basis, I could use 8 bars. But you can see right in here, we're getting some trending and a lot of chop, and sometimes it's just a little bit too much. And overnight, I'll either use 8 or 6 for my Unirenko. And you can see right here, 6 on our daily basis. You're getting way too many signals. In, out, and it's not good. You got to go to a higher time frame, a longer number of bars. Now, let me tell you, that is good for Dow. What's good for NASDAQ is 10 or 8. And I found that one of the best ones to use for the S&P is a 3 or 4 Unorenco, depending upon how much volatility there is. We should be on a 4. We just got a sell signal on the 3, but in fact, we're probably not a real sell until 76. Now I'm gonna say one thing. I did not cover what these lines are, with these levels. Those are swing levels. Those are just basically where price has been, plus or minus a bit. Make a scanner available on TOS. What do you? I don't understand. Are you talking about my list? It's just basically a watch list. Now the scanner itself, right here, is not TOS based. It's built by, it's indigenous built. Excuse me, I gotta step aside 1 second. I'll be right back. Okay, sorry about that, but when the wife calls, I pick up, and we're okay. Now, Elizabeth, will you make your scanner available on Thinkorswim? If you're talking about this stock scanner here, yes or no? Or are you talking about just a watch list? Well, that's not TOS. That is standalone. Yeah, well, I don't know about happy wife, happy life, but I definitely know the opposite of that. You know, one thing about being in a trading room, we have a good time, and we share ideas. It's almost like a coffee clutch or something like that. But the whole idea is that we feed off each other. And just because I have a scanner available here, and I'm going to have it available for everybody to watch, and you could watch that even if I'm not watching. There was one that I should have been in earlier today that I kicked myself in not being in. It was Marsh McClellan, MMC. Look at this puppy. Ran from the open till about, oh gosh, what was that time? We topped out at, what time was that? 11:45, noon? And that's usually what happens, at 11:30 or so. Yeah, and it keeps our sanity. We bounce ideas off each other too. All right. Trade ideas and other ideas. Charting, you name it. Elizabeth, if you're interested in that scanner, I have no idea about availability time and pricing, but it will be fairly soon, within the next 3-4 weeks, I bet. Don't hold me to it. I'm not the developer. I'm just one of the beta testers and users. But I'm sure you'll be given an opportunity for that. It's called the Live Trading Alerts, LTA. So if you hear anything about LTA, where would I have entered and put stops and whatever? Well, this is a 15-minute chart. So let's go down to a 5. Let's go over here to the left. And it's awfully easy to say what you would or should have done. All right. Shift L, get just the whole thing. Let me go to a 2-minute chart. Hold on. You're welcome. Yeah. Woulda, shoulda, coulda, right? But this is how we learn. All right, here was 2-minute chart. You could go long above the 2-minute chart. I'm looking at my stochastics RSI setting here. Maybe it pulls back and you wait for the pullback. But guess what? I'm seeing it pull back here, and I'm seeing it pull back here, but I see price start to go up before stochastics confirms it. There was a divergence. Now if we go to a 5-minute chart, let me pull this over. That's not so bad. Even if we went long about $80, we only had to take heat to about almost $1, 75 cents or so. Our stop would have probably had to been all the way down 78, 75 or so. It would have had to been a long ways down. Maybe below the average true range. This is called a chandelier stop. And you notice that once we got going in the day, it didn't roll over until we got to about 11:45. And if I go look at a 15-minute chart, this is the 15-minute chart. I usually go, like I said, between 10 and 10:30, and that's when I look for late entries, using a 15-minute retracement pullback. So if this would go up like this, pull back, probably come down to the 8 and the 17, and then start back up. Or maybe get up to here, pull back, and then go back. Now we're getting some sell-off in the Dow. Watch it poke its head the other way. All right. Any other questions here? Let's see if Ray... Sure. There's a 5-minute. I used to work for United Technologies. Great products. All right. It had been going down into earnings, as the overall market did. And then it broke up through the downtrend. And it took 10 minutes or so there's the 5-minute high. It pulled back, and somewhere, if you believe in the 5-minute opening high, 123 and a quarter to 123 and a half, you went above the body of that first candle. Could you have waited to 123.50? Yeah. Now, where would the stop be? Stop's got to be down quite a ways. If you're going to run 123 to 123.50, you're going to be down here 75 cents or so. And then you're going to trail it up. Then it started moving up. Now, the other problem that it had, let me go to a 15-minute chart. See what happened when it hit 125? Basically that area to that area, 125, 126. That's going to be a really tough one to crack. Now, let's watch that one in a longer term basis. Let's see what happens over the next couple of days. Hourly chart. If we can get over 126, this one, I think, has a chance for the 130s. But what we're getting, you're welcome, Valerie. One of the problems we're getting is that we're getting 1 day pops, and the markets are so weak that they're falling out of bed. Let me go to a daily chart and show you. Skechers, remember? Kaboom! There's where we traded it, and it's pulled all the way back. Right. PetMed Express, same thing, pulled back. What else was it that we did? Skechers and Pets. Hold on, let me look at it. PM, Philip Morris. Sorry, I haven't seen your moment there. Now, Philip Morris has kind of been marching higher. And this is what normally happens. I say normal, whatever normal is. All right, you'll get a gap up, like we did on this day right here. And then what we'll get is about a 30 to 45 degree runner to the upside. And that one would have worked. But that's the exception rather than the rule with such a weak market. Hi, Cliff. All right, any further questions? And I've got Ray, I've got to send you some stuff. I want to thank everybody for being here. I want you to seriously consider giving us a trial. If it's not convenient for you right now we have the trial on. I don't know how long it's going to be on. That's beyond my call. It's not my call. But I tell you what, you come by and visit. I think you'll enjoy it, and you'll make some money. Aloha.